Hello guys, and welcome back to a new video. In today's lesson, I'm going to show you how I use the 30%, 50% and 70% of a swing point. These are from the DTFX concepts, so make sure to check his playlist to understand market structure in depth. So I'm going to show you 3 ways of how I use these levels right here. We're going to go from basic to more intermediate and advanced stuff. All right. And these are how I personally use them, right? So for my own backtesting, from my own experience, if you use them in another way, leave a comment down below so we can all learn from each other. If you found out something new on your backtesting, make sure to leave a comment on how you use them. So let's start from basic one, all right? Which is the first top and the second top. The first top and the second top is basically something like this. Let's say that this is a zone, right? A zone or a fractal. When price is trading lower, it tends to make the first top of the zone below the 50%. So you can expect it from the 30%, like all the way to the 50%. But in most cases, it's going to be like in the 30% right here. So a shallow top, price will start to trade lower. And then one more time, the second top into deeper levels, 50%, 70%. And here you can expect the real expansion to the downside. So this one is the first top. This one is the second top, all right? So how do you make use of this information right here? That the first top usually happen around the 30% level and the second top usually happen above the 50%, right? How you can use this information? Well, you can use it in 2 different ways. First of all, you can take a quick scalp right here, right? You can take a quick scalp when price start rejecting from the 30%. And what I like is that I want to pair this first top with a liquidity sweep like this, something like this. Maybe price generated a high, right? Inside this zone, price started trading lower. One more time, sweeping this. This is the first top because it topped only on the 30%, start trading lower. So what you can do is you can pair the first top, the 30% level with the liquidity sweep, and then trade lower. Take a really quick scalp, and you need to be very conservative with your target. And then you can expect this second top right here, and this is the second use. The second use is that you don't trade the first top and you trade the expansion leg. So pretty much most of the time, first sellers will get stopped out. People who like to sell at the first signal, they will get stopped out. So don't be the first seller right here. Don't try to catch the top, all right? This is an uptrend right here. Don't try to catch the top right here. Wait for this all to happen. Wait for this to happen, the second top. You can wait for the first top to end, and then you can enter on the second top, because the first top is not going to be always like this. It could be something like this, right? And you will get stopped out right here, especially if you have like a 2R or 3R target. And then you can wait for the second top, and you can read the market structure right here. Don't put just a limit order above the first top. Wait for market structure to form right here, and then you can take it lower, right? So this is the first use of the levels. And let me show you a few examples. So the first example is on the Bitcoin chart. We have a swing point right here. The first top, as you can see, paired up with a sweep on liquidity. It happened like on and just below the 30% level, right? And you wait for something to confirm that this is the actual, that price will trade lower for a quick scalp, right? And then one more time, deeper into the zone on the 50%, 70% level, you can read the market structure right here to take the expansion leg, and price traded heavily to the downside, right? Let me show you another example. As you can see here, we have the swing point. The first stop happened here on the 30%. So as you can see, this is not really a clean first stop. So this is why you might want to let the first stop pass, and then you can take the second top right to this high right here. So first stop, start trading a higher price, right? And then one more time digging deeper into the zone, and now we are trading higher. And here, of course, price couldn't break above this high, only a wick, and then traded to the downside. We have talked about this a million times. Let me show you another example. We have a swing point right here. First stop into the 30% level. Price started trading lower, and then one more time deeper into the zone, into the origin of the move, and now this is a real move, right? Another example, let me zoom in. We have a swing point right here. First stop, price started trading higher. One more time deeper into the zone, right? And then the real move happened. Of course, price will not always print the first stop at the 30% level exactly, and the second top it will be like on the 70%. It doesn't work like that, right? But keep in mind that the first stop usually happen at the 30%. This is where you can expect the first stop, so you won't get trapped into that fake move to the upside, and then one more time price will sweep that into deeper levels and then trading higher, right? Moving on to the second use of the levels, and this is something that I have talked about many times in my previous videos. I don't know if you paid attention, but I always say that a lot of times it will leave highs, right, or lows. Let's say, for example, highs in this example. In this example, we're going to use highs. Or in a bearish trend, it will leave highs, print highs, just below important level, like the 30%, 50%, 70%, right? So, for example, a high just below the 50%, right? Price will start trading lower, and this is one of my favorite setups. When I see this, price will trade lower, and then one more time, it's liquidating this, sweeping this high into an important level, right? And then trading lower. This happens pretty much all the time, every single day, multiple times per day. And let me show you examples so you can understand it better. So this is a beautiful example. I analyzed this chart, this trade specifically for this video. So I went into the chart and I was looking for that same pattern, which is creating a low or a high just below or above an important level. And I saw this, right? We are on a swing point, and this is the previous example that we used, the first top, second top. So as you can see, price printed a high just below the 70% of the zone, right? And then price trading here, failed to take this, trading lower, and then one more time trading into it, liquidating this and this one, the highs just below the 70%. And this is what we like to see, a sweep, and then fail to close above the range, right? So above this high right here, fail to close. And then what happened? A CSS confirmation. What happened next is that this should be your entry, and this is a very conservative target. But as you can see, price traded way lower. So we have this, a high just below the 70%, paired up with the first top, second top. So we already have the first top, this is the second top, and this is the signature that we like, a high below the 70%, sweep it, CSS, and then trading lower. And look what happened. Let me show you another example. All right, this is a beautiful example also. We have a swing point, we have 3 lows just above the 30% of this zone. Price traded here, one more time trading higher. We don't chase price, we let it come to our level. So here, traded to the downside, tapping into the 30%, liquidating all this. So this was on the 15-second time frame, and as you can see on the 15-second, we don't have that close back inside the range, so we closed below the low, but on the 1 minute. But if you go to the 1 minute, look what happened, generating another low just above the 50%, sweeping that low, right, close back inside the range, the CSS confirmation happened here, and this is the result. Price really expanded to the upside from that CSS, after that CSS, and that liquidation of that low above the 50%, right? Beautiful example. Another example right here. This is also, we used it as the first top and second top, but look at this. Price created this high, this low, just above the 50% or the 30%. One more time, sweeping it into the 30% and then trading higher. And then look at this low, just above the 50%. What happened after a few hours? Liquidating this high, this low, into the 50% and then trade it higher. So what you want to do is you want to watch out for highs or lows near important levels, 30, 50, 70%. What you want to do next is you want to wait for that liquidation of that high or low, the CSS confirmation, and then take your entry. All right. If something like this happened, so we have this high below the 50%, price liquidated this high, but it didn't top into the 50%. Wait, it doesn't worth it, guys. Even if this move happened and you never got the top into that 50%, it doesn't matter. A lot of times price will come back one more time, tops into imported level, and then coming to the downside. All right, so if you missed a move, two moves, it doesn't matter. For me personally, it's better to wait for price to top an important level, and it happened a lot of times actually. Price will print those sweeps, I chase price, and then one more time topping deeper into the zone. Now the final use of the levels is for the entries, right? From where I take my entries. When do I take my entry on the 30%? When do I take it from the 50 or the 70%? So to determine that, we need to determine whether we are on a pullback or an expansion on the higher time frame. So for example, are we expanding to the upside? Are we trading with the higher time frame, or we are pulling back on the higher time frame? You need to determine this. Let's say, for example, we are pulling back on the higher time frame, all right? Let's say, for example, the 15-minute, we are trading lower, but only as a pullback, not an expansion or something like that. And on the lower time frame, I like to see this pattern right here. I like to see price sweeps a certain high right here, and then the CSS confirmation, right? Close back inside the range. And we want to see price coming back to the range and then take our entry. So on the pullback, and let's say, for example, this pattern right here happened here. So as you can see, this high swept this high right here, and we are trading lower. So we know that we are trading lower only for a pullback. Since we are trading against the trend, as you can see here, we are bullish, right? So the bearish momentum is weak, right? So a lot of times price will do deeper pullbacks into the range, right? It will not just expand really quick to the downside. No, it will do deeper pullback into the range and then trade lower, right? So if I'm trading against the trend and I'm trading in a higher time frame pullback, I like to take my entries from the 50, 70, right? Sometimes I wait for a deeper mitigation on this zone, especially if the stop loss is too wide, and then I'm going to look for another sweep inside here, another confirmation. But a lot of times when we are pulling back on the higher time frame, we are going against the trend, price will do deep pullbacks since we are more bullish than bearish, right? And also, you really don't want to enter here. Let's say, for example, this candle closed here. You don't want to enter from here because your stop loss is going to be too wide and you don't know how much price is going to pull back. Sometimes price will pull back only to here, right? Let's say you target something like here. The pullback is going to end here and then price will reverse on you. So it's better to wait for the deeper mitigation, that deeper retracement into the zone, maybe the 50, 70. A lot of times I see that the price will go all the way to the 50%, right? So most of those times it will top to 50%, few times it will top to the 70%, but 50% has a really good ratio, right? So this is the best level to enter from, and you want to take trades from levels because you don't want to have a second thought when it's the time to execute. You don't want to think long on when to enter. You want to make it as mechanical as possible, especially the entry, all right? Because that's where we hesitate the most, all right? So 50% is a good level to take trades from. If you have a target down below right here, maybe you can take it from the 30%, right? But this is up to you. Now, let's say, for example, we are trading with the higher time frame. So let's remove this. So let's say, for example, this pattern right here happened here. Now, we know that the higher time frame is bearish, right? And we have that pattern that we are looking for, that's entry model. We have this sweep above the high, close back inside the range, and then the CSS confirmation here. You don't want to wait for that deeper mitigation on the 70 and the 50%. Price will not give you that. Most of the times price will not give you that deep mitigation. It will quickly expand to the downside. So the 30% level is a good level to take your entries from. Maybe you can take it right at the 0%, right, of the zone, but you don't really want to wait for those deeper levels. And this is not just applicable for this formation of 3 candles. It can be something like this. So this is, maybe this is on the 1 minute, so on the 5 second, the 50 second, it will be something like this, so that market structure shifts, right? So now this becomes the zone from this low to this high. Also, don't wait for those deeper mitigations. Most of the times it won't happen. We are trading with the higher time frame. The bearish momentum is too strong, so you will not get those deeper mitigation. 30% is more than enough, right, for a pullback to the zone. And here you can take your entry. So to summarize things up, basically, if you are trading with the higher time frame, don't be greedy and wait for these levels to get hit. Take it from the 30%, the 0%, right? If you are trading against the higher time frame, now you can wait for those deeper mitigations. You can expect those 50-70% levels to get hit, so you can have a reasonable target, right? Not something like this. Don't force a deep pullback. Now, these things that I've said, it doesn't work 100% of the time, all right? But it works more than 50% of the time, all right? So it's like 70-30, right? 65-35%, and we are trading with probabilities. So just because you saw like we are trading with the higher time frame, this setup happened with the higher time frame, and we had a deeper pullback, right? Then you're gonna apply this to all your trades. You're gonna miss a lot of trades. Out of 10 trades, maybe you're gonna catch 2 or 3 of them, right? And that's not good for the psychology. And now let's move on to some of the examples that we have. So let's start with the first example, and notice here, this candle right here, this is on the 1 minute time frame, right? Since this is a pullback, right, we are trading lower. We tapped into a zone to the left. It was way far to the left. We swept a high inside it, represented in this red line right here. Not the best example, not the cleanest example, but follow me for a second. This red line represents a low that was inside the zone, right? As you can see, we swept it, and then we have the CSS confirmation right here with this candle. So now this candle is the whole range, and see how price returned back all the way to here, a deep retracement into the zone, right? And then we traded higher. So here's that trade. So this is on the 1 minute time frame, and now this is on the 15-second time frame. See how deep was the pullback, and inside the pullback we had also a few sweeps, and then we traded higher, as you can see. Another example, see, this is the 15-second time frame. Price was trading higher. We swept a high right here. So now we know that this is only a pullback into maybe this zone, and then we're gonna keep trading higher. So since this is the pullback, we can expect a deeper mitigation. So as you can see, price traded all the way to here and then traded lower, right? Another example, as you can see, this is on the 1 minute time frame, are trading higher. We swept this high, we can expect some kind of mitigate or a pullback into maybe this zone, sweeping this. The pullback didn't sweep this, but if you maybe took a trade right at the close of the candle, right here below this candle, you will not get your 1-to-1. Price will not give you even a 1-to-1. Your stop losses would be too wide, right? And you will get stopped out. But if you waited for a deeper mitigation, maybe the 50%, as you can see, price gave you that 1-to-1 from the 50% to here. So since this is a pullback, we had a deeper mitigation. This is the 1 minute time frame. If we go to the 15-second time frame, you can look for a refinement. So as you can see, this candle right here swept the high here and then closed below it, CSS confirmation. And we have a deep mitigation, a deep retracement, like the 50. This is the 70% stop loss here, and price would have given you like a 1.5 R or something like that. Another one, this is also a pullback, right? Price trading higher. As you can see, we have the CSS and the sweep happened here. Deeper mitigation into the zone, like this is like 50%, and then we are trading lower. And as you can see, price eventually the pullback was too short, and then we traded higher, continue our direction. This is expansion, right? So now this is an expansion. We are trading expansions. Expansions a lot of time won't even give you the 30% of the times, and we're gonna fix that in another video, in the next video maybe. I'm gonna tell you how you can catch these kind of trades. As you can see, the CSS happened here with this candle, and price never returned back into this, right? So because we are trading with the trend, expansions would happen very, very quickly. Let me show you another example right here. We are trading with the trend, price returned back. This is all a pullback, returned back, all right? Swept these highs right here. We have the CSS confirmation, closed back inside the range, closed above the candle, and this is only a 30% top, not a deep mitigation into it. Another example, we are trading lower on the higher time frame. This is a continuation move, swept this high right here, close back inside the range, CSS confirmation, only a 30% level get hit of this candle, and then we traded lower. This is how I use the levels of a swing point. You can use it on a swing point, you can also use it on a candle itself, you can use it on a fractal, right? So I believe that this is the end of this video. If you have any questions, leave them in the comments or DM me on my Twitter account, and I'll answer you as soon as I can. Now happy trading and good luck.